If we look at interest rates, unbelievably happy here. They've stayed low for the last 12 months. They're unlikely to go up. We're sitting at an official rate of 0.1%. The RBA has on record for now the last 18 months or so to say they did not expect to put interest rates up for 2 to 3 years, and they've held that line. We basically now just get a formality of an announcement. Interest rates are the same. But there's no room to go down, but there's room to go up. But if we look at global ones, policy interest rates around the world, you can see, some of them are in negative interest rates. That's phenomenal. Who would have thought that could ever happen? But it is going on now. Now, one of the things that you need to be mindful of is we haven't had a rate rise for a long, long time now, since November 2010. And it's the old saying, what goes up must come down, what goes down also has to go up. So I still believe, and I'm holding my line here, that the next shift is up. I can say that because there's no possibility of any further down, to be honest. But the economy is strong. And one of the things that the RBA does look for is CPI, Consumer Price Index. And you see in that bottom graph, that's now above their happy range. They like it to be in that 2 to 3% range. It's now pushing up way past that. So things are getting more expensive because of that consumer activity, because of the fact that goods are getting up because it's harder with supply chains. So that's going to give pressure on the RBA to look at bringing interest rates up sooner. One of the key drivers of CPI, house prices. House prices, as you'll see soon, are doing extremely well. A lot of people blame interest rates for that. I'm not in that basket myself, but it's certainly a factor. And one of the ways they can cool the house market is to lift interest rates, and that therefore has a dampening effect. So expect interest rates to go up in the not distant future. They said that they won't put them up, but I think they're going to be under pressure to do so from a financial sense, with that CPI and with those growth numbers coming in better than expected. The only thing that might have bought us time is the fact that the Delta COVID virus got out into Sydney and Melbourne over the last 3 to 4 months, and it's still probably a month or 2 months away from being able to come back to a level of normality. We don't want them, but they're going to be absolutely necessary to see those rises. As a result, you really, really, really should be considering, if you've got debt in Australia, looking at fixed interest rates. If you fix your rate, you will not be concerned with any rate movement in the next 6, 12 months or up to 5 years. So if you're happy with your interest rate right now, you should seriously look at getting it reviewed and consider a fixed rate. So my prediction here is interest rates should stay flat for, I believe, at least the next 6 months, and then we're going to have to start seeing, logic-driven small increments depending on the strength of the economy. But to give you an idea of how powerful those fixed rates are, here's a quick chart for you, and you can see the variable owner-occupier rate in Australia is from around about 2.29, and indeed there is even specials underneath that from time to time. As long as you go principal and interest these days, you get a little bit cheaper than if you're an investor or if you go interest only. So there's a small investor premium, there's a large interest only premium. 2.29 is an occupier principal and interest, 2.89 if you go interest only. So you're far better off taking that lower cost than going interest only. The only time you should look at interest only is if you can't sustain the principal repayment through your cash flow. But you've got to be careful because the banks may be reluctant to lend you there. But definitely you want to be taking advantage of that principal and interest, get some equity in your property, get some debt reduction, it's there. But if you look there, the 3-year fixed rate is 1.89. That's phenomenal. So that tells you that interest rates are likely to stay low for the next 1 to 3 years, and that the banks are willing to lock you in at that rate and therefore, make that profit on you. If you want certainty for that period, it's worth it. Now the 5-year rate there at 2.49, that's worth considering, but you're paying 0.6% more over the first 3 years than if you had fixed it for 3. So that's 1.8, and you've got 2 years that you wouldn't be fixed. So you're hoping that for that last 2 years, if you took a 3-year instead of a 5-year, that 1.8 divided by 2, 0.9, that interest rates are 0.9% or less than your 3-year fixed rate. If that's the case, you got it right and you save money. If interest rates are higher than 0.9 more than the 3-year rate, then you would have been cheaper to go a 5-year rate. It's a little bit of a lucky dip. It's a tough call, but you pick what you're comfortable with and what you like to have a certainty. And certainly over the long haul, it's certainly worth considering. Interestingly, you'll see owner-occupier rates for interest-only repayments are much higher than any of the other rates. And the reason is the banks are being very much discouraged by the government and internal policymakers to give interest only on owner-occupier homes. They don't mind on an investor because it's a disposable asset, but a home needs to be kept, and therefore they're reluctant to give you incentive to go interest only on your home, but they don't mind it on an investment property. So you definitely, as an owner-occupier, want to go for the cheap principal and interest reduction. Now, I've spent most of my career telling people to go interest only, interest only, interest only, because a principal reduction is not a tax deduction. But for most of my career, the interest only and the principal interest rate was the same. So there was no financial impact either way. Now, the principal and interest repayment is significantly cheaper at an interest rate cost than the interest only. So you should always go for the least cost, most efficient, and best for your finances. And that now is pushing everybody towards principal and interest if you can afford it.